Now, last time we are discussing about financing, types of financing. So we're going to continue and we're going to watch and learn about equity capital. Our first topic is dive deep into equity capital. I would like to request all of you, please do watch with full concentration till the end so that you can grasp most subject target and reach your own destination and clear about the subject and you can access to it. Let's move on. What is equity capital? As I already said that in earlier chapter we discussed about equity, no, not equity, financing and types of financing and sources of finance and that's financial needs. Now we are moving to the equity capital. Equity capital. Let us understand what is equity share capital. Equity capital, or we may call equity share capital. It's the same thing only. A company which wants to raise funds from the owners, they issue this equity capital. So a company which wants to raise funds, a company which wants to raise funds from the owners, they issue this equity capital or equity shares. By short, equity shares. By issuing equity shares, raise money from the owners of the company. Let me repeat once again. By issuing equity shares, raise money from the owners of the company. Equity share capital are called as a permanent sources of funds, right? Myriad lenders. I'll try to explain later on. Permanent sources of funds. Permanent sources of funds. Equity share capital are called as permanent sources of funds because they need not be repaid. Because they need not be repaid. That's the main advantage point, that they need not be repaid. And they are a permanent sources of funds. The company is until the company is wound up. So the shareholders of equity share are called equity shareholder or ordinary shareholders. And those who own equity shareholder are called owners of the company. They are the owners of the company. Of course, we know that shareholder and those who own equity shareholder are co-owners of the company because they take highest amount of risk. They are called the owners of the company. At the same time, they take highest amount of risk and they are entitled to claim dividends paid after meeting all the expenses. They are entitled to claim dividend. We are not sure and we are not here specified that about the face value and all, but they are entitled to claim dividend. But paid, after paying all the meeting expenses, they can claim dividend. So dividend is a proportion of profit, not charge against profit. Okay. Dividend is proportion of profit, but not charge against profit. So that they entitled to claim what is known as dividend. As we listed here, if the company is wind up, the event of winding up of the company, they are entitled to claim share on the assets for their capital invested. Right now, I'm stating out that about how they claim and how they are entitled to claim dividend, and they take highest amount of risks, and the cost is very high when it comes to equity. Equity shares are in a company. This would give security to others too. And they are entitled to claim share on the asset. And let's take a look back that company on the event of the winding up of the company, they are entitled to claim share on the asset. So let's write here in the event of in the event of winding up or in the event of dissolution of the firm or the company, they can claim share on asset. which they have already invested in the company. And as we already stated here, the owners of the company equity share capital are called as permanent, permanent sources, permanent sources of funds because they need not be repaid until the company is winding up. The shareholders of equity share are called shareholders. And those who own equity shareholder are called owners. You know the owners, owners of the company because they take high amount of risk and they are entitled to claim dividends. So dividend is appropriation of profit. Dividend is appropriation of profit, but not charged against profit, so they entitled to claim what is known as dividend. If the companies win up the event of winding up of the company, they are entitled to claim share on asset. As you write here, on the event of winding up of the company, shareholders can claim share on assets which they already invested in the company. And generally, the cost of equity shares will be very costly. Will be very costly. Generally, generally the cost of equity shares are very costly because they are taking a very high amount of risks. Why it's costly? Because they are taking very high amount of risks. High amount of risks. So the cost is very high when it comes to equity shares because of risk element. Because of risk element. But if there is more number of equity shares in company, this should give security to others like lenders, as I stated here. This would give more security to others like lenders. Lenders are interested in looking what is the amount of shares in a business or amount of investment made by the equity shareholders. And if that amount is high, it's going to give them comfort because of DT ratio. Your DT ratio. I just put in rows, short form this one. What is the amount of shares in business or amount of investment made by the equity shareholders? And if that amount is high enough, or if that amount is so high, it's going to give them comfort to the shareholders. because of the DT ratio. Here, I think that's all for equity share capital, how its functions and repeat. This is equity capital or equity share capital. We can call that. We can call that here. A company which owns to raise funds from the owners. A company which wants to raise funds from the owners, they issue this equity capital or equity share to raise funds from the owners. They issue this equity capital or equity share capital, right? And by issuing equity shares, you raise money from the owners of the company. Equity share capital are called permanent sources of funds. Equity share capital are called permanent sources of funds and they need not to repay it. No need to repay it. Unless and until the company is owned out, winding up. So the shareholders of equity share are called equity shareholder or ordinary shareholder. And those who own equity shareholder are called owners of the company. These equity shareholders are called owners of the company and they can present and participate in the e-voting and annual general meeting, etc. Because they take highest amount of risks. Because they take highest amount of risks and costly. At the same time, equity shareholder can claim dividend, which called appropriation of profit. But after meeting all expenses, okay? So dividend is appropriation of profit, not charge against profit. So they entitled to claim what is known as dividend. If the company is went up, in the event of winding up of the company, they are entitled to claim share on asset. In the event of winding up of the company, shareholders can claim share on assets for which they already invested their capital, so they are entitled to claim share on assets. And generally, the cost of equity shares will be very costly here, and risks also issued high amount of risk. So the cost is very high when it comes to equity shares because of these risk element. But if there is a more number of equity shares in company, this should give security. This should give security. This should give security. If there is more number of equity shares in company, this should give security to others like lenders, lenders, Lenders are interested in looking what is the amount of shares in a business or amount of investment made by the equity shareholders. If that amount is high, it's going to give them comfort because of D ratio. I hope that everything is clear regarding equity capital or equity share capital. About shares, claim, dividends, and appropriation of profit, and after meeting all expenses, and it's costly and it involves high amount of risks. In the event of winding up of the company, shareholders can claim share on assets, but after meeting all the expenses, after paying all the expenses, and the lenders are interested in the high amount of risk and just to give them comfort in the form of the ratio, and shares are permanent sources of funds. So I hope you can move on. If anything is unclear or if anything is unclear or doubt is there, then you can give me feedback regarding the subject topic. Now we are going to study advantages of equity capital or equity share capital. Let's see. Having equity, it is a permanent source of finance. First of all, as having equity, it is a permanent sources of finance. Permanent sources of finance. And it need not repay until and unless the company, say companies, own out, and it's improve financial base, it's improve it improves financial base, financial base, or maybe financial strength of the company, which is very important for strengthen network, make company very attractive for the outsiders or stakeholders. In case of net worth, it strengthen the net worth and make company very attractive for outsiders or stakeholders. It make company looks attractive for outsiders like stakeholders. Outsiders like stakeholders. Payment of dividend is not mandatory. Company can make issue by way of further issue. Existing shareholders get preference. Let me put in rights issue. If I put in rights issue, I think this will cover the main aspects. So the advantage of equity capital or equity share capital, the first one is permanent sources of finance, and it improve financial base or strengthen the network, and it makes the looks appeals or attractive for the outsiders like stakeholders. And in case of right issue, payment of dividend is not mandatory. At the same time, company can make issue by way of further issue. Existing shareholders can get preference. Though payment of dividend is not mandatory, companies can still make issue by way of further issue, and then the existing shareholders get preference. I hope up till now everything is clear. So as I already mentioned that if anything is unclear or anything is doubt, you may convert to the feedback option and you can comment and you can mail me, which I'm gonna put in my description box. So let's advance you. Now we're going to take an opposite look of equity capital, equity share capital. We just have discussed about the advantages of equity share capital. Now the upside is disadvantages of equity capital or equity share capital. I hope that everything is clear till now. So as I already said that if anything is unclear, then you can get back me to my mail ID, which I'm going to provide in the description box and feedback option in the comment section. All right. Disadvantages of equity capital or equity share capital, right? So investor would reluctant and shift to debt instrument. Issue of new shares will reduce existing shareholders. Issue of new shares will dilute the ownership and existing shareholders. Because of all this, why? The first one is very costly. The first one is very costly, and the second one is, as I already mentioned in the earlier chapter, very risky. The term equity in case of mutual fund or just for the sake of knowledge, equity. If you invested your money in mutual fund in equity option, lots of risks is involved. Lots of risks involved. In stock market also. In stock market also, lots of risks involved. No, no interest on capital. No interest on capital. So let's go back to the disadvantages. Let me write here issue of new shares. Issue of new shares. As I already mentioned that as investor reluctant and shift to debt instrument, issue of new shares will reduce existing shareholders. Issue of new shares will reduce existing shareholders or existing investor. It's the same thing. It's similar. Shareholders, existing shareholders or existing investor is the same thing. And the next disadvantages, dilution or dilution. Why dilution? Issue of new shares will dilute the ownership and existing shareholder. Issue of new shares, how dilute? Issue of new shares will dilute ownership and existing shareholders. Right? So the disadvantages of equity capital or equity share capital is that the first one is very costly and very risky, and if you invested your hard-earned money in mutual fund in equity sector, it involves lots of risks. Stock market, equity, risks. When it comes to equity in terms of investment in mutual fund and stock market, it involves a lot of risks. So issue of new shares reduce the existing shareholders or the existing investor, and what come what comes next year? Issue of new shares affects dilution. Dilution affects both ownership and existing shareholders. I hope that everything is clear. If anything is unclear, then you can get me back at the feedback option or my mail ID, which I'm going to provide you at description link. So now we have already studied and already watched what is equity capital, what is equity share capital, and what are those advantages and what are those disadvantages of equity capital, equity share capital. That's all for this time. Thank you so much. Please continue follow me and do watch my videos for gaining knowledge. Thank you so much. See you next time.